All right, so welcome everybody, and thanks for joining me. We're going to be presenting Brentlinger Park Apartments, or townhomes, and just a couple things before we really get started. And I'll probably say this again at the end, but the portal is open, ready for investment, so you can invest now. This is a 506C offering. It's a little bit different than a lot of our offerings, so you have to be accredited in order to invest in this deal, and you have to go through the accreditation process, which is pretty simple. We've got it right on the portal. It goes through parallel markets. It should take you less than 10 minutes to get through that process. So I know it's sometimes a little annoying to get through that, but it shouldn't be too bad. So, all right. I'm going to play a quick video here. And this is just of Brentlinger Park. So the townhomes, this was built in 2023, mainly 2023 and 2020. Well, started in 2022 actually, and so they would build and they would start leasing out each building, and finished in late 2023, early 2024. They officially got the certificate of occupancy in 2024. So it's a brand new build construction. You can see units are really nice. They're open, they're spacious, they're townhome units, which is really nice because it provides just I guess, different demographic, a demographic that's likely going to stay there a lot longer. They're two bed, 2.5 bath, so 9-foot ceilings, 1,300 square feet. They got vaulted ceilings on the upper level. Granite countertops, under mount lighting cabinets, just really nice. And then a nice clubhouse too. It's in a fantastic neighborhood. So neighborhood is fantastic. It's a growing neighborhood. There's a lot of new stuff going in that little sub market there. So really good stuff going on. We love kind of what this deal is. So, all right, I am going to then switch my share. Let's see. Over to this, so bear with me. Thank you for your patience. And okay. So again, Brentlinger Park Townhomes. This is a mark-to-market deal. So what that means is, so this is a seller who it's sold directly to us by the builder. So this is a builder. I mean, that's what he is. He's a builder. This is what he does day to day is he builds houses. He builds single family homes. He builds a lot of single family home developments. And he's started to do these townhome developments. And so his main goal of objective is to build. He's trying to get in and out of these properties. He is not a property owner. So what that means is he's not trying to maximize rents as much as possible. He's trying to get this property occupied. He's trying to get people in. And you can see even like when he first started renting to when he finished renting, the rents went up drastically as he was kind of getting it leased out, or I shouldn't say drastically, quite a bit though, as he got it leased out. And his main goal is to get out of the property quickly. It's all about velocity for him. So that what mark to market means is that our job is now to bring it up to market, right? His job was to get it leased and sold. He wanted to get it to qualify for agency financing, which he did. And then our job is to take it from where it is today and to bring it back up to market. And when we talk with the on-site that's there and said, what do you think? Do you think you could raise rents, another $100 or so? She's absolutely, like, not a problem. And I was just there not that long ago, and I said that again to her. She's like, oh my gosh, it'd be so easy. So there's a lot of room there. The other thing too that I like about it is he was, his expected sale price was 30 million. We're buying it for 24 million. So we're really getting a 20% discount on what he expected when he first started this project. Okay. Talk a little bit about Endurus. Most of you guys know who Endurus is, but Endurus Capital, we are mainly multifamily assets, and we're focused in the Midwest. So Twin Cities, Minnesota, where we are, where we're based, and then we've got assets in Kentucky and Ohio and Tennessee as well. So it's myself, it's Drew Witz and Matt Bronner. We are the principals of Endurus Capital. Drew's on with me as well, and Matt is he's on, but he's traveling right now, so he's not visually on. So we are the partners of Endurus Capital. And together, we've operated over $500 million in multifamily commercial assets across the U.S., mainly in the Midwest. Um, why Endurus? Look, we our goal is to try to provide strong, predictable, risk-adjusted returns, streamlined process. We've got a portal. We try to make it easy for you to invest. We've got help that can get you into these investments, into your 401ks, IRAs, cash, whatever you're going to invest with. We invest alongside of our investors. And really, our big goal is to provide clean, safe, welcoming apartments. So with that, we know we can provide value to our residents, communities, and then that trickles down to reliable outcomes for our investors. So that's kind of why Endurus. The three of us, like I mentioned, Matt Bronner, myself, and Drew Whitson, and we have quite a bit of experience in real estate. Drew is a finance professor at Bethel. He's got a lot of experience in kind of the corporate and finance, investment banking. Matt's our management side of the business. And so he's got a lot of experience in that investment side or in that management side, bringing that. And I have a lot of experience in the construction side as a licensed contractor and doing a few flips here and there. Zach Heidings, our acquisitions director, Daniel Simpson, our director of asset management. Daniel's been in the business for, I believe it's 35 years. He's done a lot in property management and in asset management. So he comes to us with a lot of experience. He's the one watching over the property day to day. The three of us are as well, but Daniel's really digging into all of the details, making sure things are running smoothly. If you've got any investment related questions, portal related questions, any of that kind of stuff, Tracy Dexheimer, she is the director of marketing investor relations, and then our bookkeeper, Amy Ludwig, director of accounting. All right. Here are some of our recent transactions. You can see some of our purchases in multifamily. We recently purchased Regency Park Apartments in North St. Paul that we just purchased at the beginning of this year, paying investors their distributions right away. So that one's a fun one to start off with. The commercial, we have a couple commercial assets, Times Square as a retail strip center. And that's fun. If you're in the Twin Cities, go check that out. Times Square in Apple Valley. It's a really awesome place. We did a massive remodel and it turned out really, really well. Parker's Lake MedTech is office industrial building over in Plymouth, Minnesota. And then we've sold quite a few properties, and we just listed a couple here. And you can see those properties and kind of the returns. Of course, returns are subject to market and all that kind of stuff. So, all right. Last thing before we really dive into the market and the property, why multifamily? One of the things I really like right now that's going on with multifamily is that we are seeing really high absorption. And what happened is, and this is really prevalent in the South and Southeast and West, there's been a ton of building, and there still quite frankly is. There's been a lot of deliveries. And so you maybe hear on the news cycle about all these deliveries, about everything that's happening, and multifamilies getting crushed and rents are going down. Well, that's happening in the South and the Southeast. That's happening to markets like Austin and Phoenix and Dallas and you name it, right? So you're seeing that there where they've had a ton of building, and they still are. They're going to have a lot going on in the market in 2025, but that has really slowed down. When we're looking at the permits that are out there right now and just getting going, that's fallen off a cliff. And that's fallen off a cliff not only in the South and Southeast, but it's also fallen off a cliff in the Midwest, which never had that huge surge of building. And so what that means for us is that in the Midwest, we haven't seen the negative rents that a lot of the rest of the country has seen. We haven't seen that. We haven't seen huge vacancy rates, but we are benefiting that construction has really shut off, and it's due to high interest rates. It's just due to the overbuilding that has happened. And so there's just less building right now. The cost of building has gone up so much. So there's less building happening, which means for us, we feel that rents are going to continue to grow pretty nicely over the next 3, 5+ years. So we're excited about what's happening in multifamily. Of course, if you're in some of those southeast markets, you're not feeling that yet. You're still seeing the rents going down. You're still feeling that pain, but eventually it'll absorb and catch up, and those will be fine too in the next couple of years, but they might take a while to shake out. Um, why else do we like it? Reduce volatility when we look at multifamily versus other markets? I mean, it's just a basic human need is that you got to have a place to live. Cash flow, we love the cash flow. This property will start off with cash flow distributions right away, and we anticipate those to just continue every single quarter. So we love that. Strong historic returns. If you match multifamily to S&P, it beats it every almost all the time, but historically it just does better. Great hedge against inflation. Of course, we've seen inflation, we've experienced inflation. Real estate's a great hedge against inflation. And then the other thing, the last thing I really like is I hate like the constant news cycle in the stock market going up and down because somebody sneezed too loud. Real estate just doesn't have that, and so I love that. It drives me nuts in the stock market sometimes where I'm like, what is going, like, it doesn't make any sense. So real estate just doesn't have that. Of course, we do have ups and downs, but they're not like a daily thing that happens. All right, so what's going on in the market? So this Brentlinger Park is in Louisville, Kentucky, and you can see Louisville on the map. So Louisville is a logistics hub. It's 60% of the U.S. cities are within a one-day drive of the metro. A huge population within just 5-6 hour drive of the metro. So it's a big logistics hub. It's got major employers like Humana, UPS, Ford, a lot of healthcare, Kroger, and then University of Louisville. And of course, we all love the Kentucky Derby, so that's there. That brings in a lot of people to Louisville as well. Some key things, some key demographics about Louisville. Population's strong and it continues to grow. One of the things that I love about Louisville that's happening right now is actually been one of the top U.S. markets for job growth. And I believe, don't quote me on this because I got to look at it again, but I was reading an article the other day and I'm almost positive that Louisville was number 2 in the country for job growth. So it's really, really strong. We're seeing great job growth. We're seeing great income growth along with that. So it's got some of the best income growth as well in the country. It's got great economic development. It's just a lot of things are happening here and companies are moving in. It's got the city and the Chamber of Commerce have really done a good job lately driving industry into the Louisville market, driving new companies in. So it's a great growing market. Close proximity, where Brentlinger is in particular, close proximity to downtown, easy to get there. This area in particular that we're at has a lot of retail happening. It's a lot of restaurants going on, a lot of new things happening. There's a Hy-Vee, which is, if you don't know Hy-Vee, I don't know, I wouldn't call it like a super high-end grocery store, but a nicer grocer that's going in. A lot of other developments happening in the area. When you look at it, you can see it's vibrant and it's an improving, growing, exciting area to be in. So we're excited for where Brentlinger is, and we know that the market's just going to continue to improve around it, which definitely helps us in the long run. Louisville, GE Appliance Park, Ford Assembly Plant, UPS, all really short drive. Rent growth. This is another thing. So I talked about employment growth has been excellent, but rent growth leads the nation or is one of the top in the nation, depending on the report you're looking at, but it's constantly at the top of the country, 4.9%. And we still have markets seeing negative rent growth yet. Louisville's seeing a 4.9% increase in rent. Median income is up, like I said, huge. It's up 46% over the last 10 years. So we've got a huge growth in household income. And lots of jobs being added too. And this is just showing the rent growth of Louisville. So you can see again, Louisville compared to some of these other markets. So these are the top 5 in the country, and these are the bottom 5 in the country. And you can see several markets are are considerably losing rent growth, and we are seeing a nice rent growth. It just compares, if you're nervous about, wow, man, I've heard multifamilies getting clobbered by negative rents. Yes, it is, maybe, depending on where you're at, right? It's all local. All right, onto the property. So you can see the map to your left. Louisville is right by the river, the downtown area, and then we are, just outside of this I-265 loop, and so right in this corner, really easy access to downtown, easy access to the airport, kind of easy access really to everywhere, being on the I-65 loop. Here's a layout of the property, townhouse style on the right. All right. And then just some pictures. Two bed, 2.5 bath, as I said. And then the reminder, it's 1,300 square feet. So really open, nice, spacious floor plans. It feels good when you walk in. Um, Higher end finishes than probably most of our competitors in the market. So that's another thing. When you look at the market, what's going on, you look at our property, you see the granite countertops, you see the cabinet lighting, you see the nicer cabinets, soft close hinges, things like that, and then the townhouse style. So it definitely is nicer than a lot of the comps in the area that we're seeing, and that our renters are going to be seeing too. And then the floor plan layout too. All right. So I've said a lot of this stuff, but it's a high-end 2023 built townhomes, very desirable A-class location. Features 113 units, 2 bed, 2.5 bath. Each unit has a lot of good things going on with it. Wi-Fi docking stations, washer, dryer hookups, the whole thing. We feel we are $200 below the market competitors. So we feel like we've got a lot of room to grow. Now, we're not projecting a $200 increase, but we feel like there's a possibility that we could get that $200 rent increase. Now, if we can, of course, that's awesome. That's going to really do well for our performance, and we're going to do excellent. But we are not projecting that. And you'll see that in a second. Right now, it's 94%, 95% occupied. The other big thing is we are getting a fixed rate agency debt. So the big thing too that you hear in the market is floating rate debt or the debt problems and things that's going on. This is fixed rate debt. So it's a Fannie Mae product, fixed rate agency debt, 65% loan to value. And we're actually going to be getting a pretty good interest rate. Now, we don't have it. It's not locked yet. It should be locked, I think, either end of next week or early the following. But right now, as it sits today, we're looking at being able to lock in around 5.2 to 5.3 percent. So we should have an excellent loan that we can lock in. And like I said, it's fixed. We don't have to worry about the market and what goes on with interest rates after we lock, which was before we end up purchasing it. Median home price. This is a big one too. I like to look at what the median home price is to figure out, are our residents competing with us, or who, our homes competing with us for our residents, right? So if median home price was, call it $200,000, well, why would they rent with us? They're just going to buy a house. But when I look at that, we're at 433,000 median house price. That means that's really expensive to buy a house, especially with interest rates. We're able to get pretty low interest rate. We're also buying down some of the interest rates, but if you're going to buy a home, you're going to be mid to upper sixes. I think right now. I haven't been shopping for a house, so somebody can correct me if I'm wrong there. But it's expensive to buy, so people are looking for alternatives, and this is a great alternative for somebody that's looking for a great place. New South Point Commons, dining, shopping. Like I said, there's a lot of great stuff going on in the area. Submarket 4.9% vacancy rate. Rent affordability is good. Rent to income is 26%. Unemployment rate in this submarket is 2.8%. Great rent growth. Great population growth. And then the other thing we like about Louisville, I get to ask this a lot, like why Louisville? Well, one of the big reasons is we love the landlord tenant laws compared to some other maybe not quite as friendly states to landlords. So Louisville does pretty good. All right, and just some amenities. We do have a fitness center and package room and those types of things. So, and then you can kind of see some stuff inside the units as well. Okay, on to the financials, and I'll talk about some of the numbers and why we feel like this is a good deal. So, again, 1,306 square foot units. Our current rents are 1625 and 1695 for the end cap unit. So there's an end cap unit, two per building, right? And the rest of them are inline units, and those are go for 1625. So we feel very strongly that we can bring the rents up on the inline units by $100 a month and the end caps by, quite frankly, $100 a month. But we're just showing 1775 for those. So that's a average rent increase about $90 a month. That we feel very strongly we can get. They're also not charging properly for cable and internet. So we can capture cable and internet charge. We should be able to get $50 a month. We underwrote quite a bit less than that, a little bit more conservatively. There's also an option to rent washer and dryers. Not everybody wants to bring their own washer and dryer or has their own washer and dryer. So we can rent those out too, and we can create some more income for the washer and dryers. Now, we didn't underwrite to be able to, charge everybody because that's just not reality. But there is some, potential upside to be able to charge, $50 a month and to maybe capture 25, 30%, maybe even higher of the market. And that's just gravy on top of what we've underwritten. So that would just add a little bit of extra cash flow. One of the things we looked at, so here's when you're trying to raise rents and you're not making improvements to the property, of course, people are like, what's going on? I don't want to pay more money for rents. But one of the things that we saw as we did our due diligence is that the vast majority of our residents earn 4 to 6 times the rent amount. And so they can afford a $90, $100, even $200 rent increase. We want to see them make 3 times the rent amount. They're making 4, 5, 6, 7 times the rent amount. And so we have a very healthy resident income population. So we really feel strongly that these rent numbers are very achievable with our current residents in place. We don't have to go and find all new residents, and that definitely causes disruption. In the market, I already mentioned this, but we've got 4.9% current rent growth. We are performing our performance, excuse me, is 3% rent growth. And then the market right now is 5% vacancy rate. A couple of our rent comps. This is a townhome development just down the road, and they are 2-bed, 2-bath. Now, our units are about the same size. We have the extra half bathroom, but they do have an attached garage, so that's definitely a benefit. But 1929, you can see on their rents, so really strong rents. We don't think we can quite achieve those because they have that 2-car attached garage, but really strong rents. This is another townhome style, a little bit different than ours, but 2-bed, 2.5-bath. You can see they're getting 1899 on there, and this is just an apartment, so totally different style. But there's just not a lot of townhome comps, but you can see their rents as well. The sale comps were very hard because not a lot has been selling. We haven't had a lot of luck buying because not a lot of product is selling, and you just really hard to find those. But you can see some of the sale comps and where they've been, and you kind of look at the price per unit. 318, 274, 352 price per unit. So we feel pretty strongly about what we're buying it at. There was a deal that sold fairly recently, and I don't have the actual comp yet, but I've heard that I can't remember the exact number. I think it was right around 250 a unit, and we're buying for just over two. So, all right. And these are the comp maps. Okay. So total raise about 9.7 million. Minimum investment is $50,000. We've got a share class, a single share class. It's a 70-30 split. It's a 7% preferred return. So you'll get that 7% preferred return. The idea is to start that, start paying cash flow distributions right away. Quarterly cash flow distributions immediately. So 7% preferred return, you get that. And then we do a 70-30 split. You'll get 70%. Our projection is a 15 to 19% IRR, 19 to 24% average annual return. So that essentially means, and I'll show you in just a couple slides what that looks like for an investment. But essentially what that means is double your money in about 5 years. So 5-year investment hold. Purchase price, 24, closing costs, loan amounts about 15.6. And you can see some of the terms here. So 65% LTV, interest rate. So we underwrote this actually at a 5.57% fixed rate. We are, like I said, likely going to be closer to that 5.2, 5.3, but we won't know until the dust settles, but we'll definitely be under this 5.57. So we have a credit from the seller that allows us to buy down. So the purchase price is 24 million, but we have a $250,000 credit from the seller that allows us to buy down our rate by 29 basis points. So we'll get whatever the market is on the day we can do that, which again, it will be, I believe it's end of next week. And then we'll get the market plus the 29 basis points buy down. So our underwriting is based on 5.57, just so you know. The actual interest rate will improve, which means we are actually going to have better cash flow than our projections. If you just look at the debt service here. So I don't want to spend a ton of time on this, but this is just our built out pro forma. This is on the portal. And I've got detailed underwriting attached. Fortunately, the portal doesn't allow me to attach an Excel document. So if you want a copy of the Excel document, I have to email that to you. Which I'm definitely happy to. Okay, this will just show kind of a member distribution. So this is based on a $100,000 investment, and you can kind of see where we're projecting cash flow to be. And I kind of looked at, hey, what happens if our interest rate goes down considerably? You get at about 50 basis points or so to the cash flow every single year. So instead of 6.14 in year one, it'll be about, I think it was right around 6.75 actually. But again, there's a lot of things at play. So, if these are attractive, then that's, about where we'll be. So total profit, if you invest $100,000, you get your $100,000 back, of course. And then we're projecting about $100,000 of total profit coming back to you. So we do some sensitivity analysis, so that way you can kind of see what happens if things go wrong, if things don't go quite as we expect. So if the cap rate at exit, if all of a sudden we're selling at a 6.25 cap versus a 5.5 cap, which, look, this is A class market, A class submarket. Like A class just doesn't flex that much typically. So could it go to a 6.25? I mean, sure, anything's possible. Has it ever sold at a 6.25 A class in Louisville, Kentucky? Not that I can find, but also data doesn't go back extremely far. So, but A class is usually in the fives somewhere. And so if the market does get worse than it is today, could it go down to 575? Okay, maybe. And so you can kind of see what happens if we don't quite achieve that. And then it just shows our equity multiple if the same thing happens. Cash flow year one, what could happen to investor returns if we see different, bad debt and concessions, changes in occupancy. So basically, occupancy, economic occupancy flex. So worst case scenario that we're showing here, look, I mean, if it's 87.5, so it's 83%. Sorry, 82% economically occupied. We're still providing investors about a 4% distribution. So you can see that fairly confident that year one will cash flow nicely. And then this is the exact same thing, except cash flow in year five. You can see if we have 82% economic or 80, what's this, 84-ish percent, 83 or 4%, you're at 7. So I love this one. This is the one that's kind of my favorite, and this is showing a break-even analysis. So what would our occupancy have to get down to in order for us to break even? Not lose money, but break even. So if we're at 62%, we are breaking even. We are not making any distributions. Nobody's happy, but we are not losing money. If we're at 64% year 2, year 3, year 4, year 5. Okay. So you kind of see we can have some pretty low occupancy and still break even. Of course, again, nobody's happy, but we're breaking even. I think most people in the market want to see like right around 75 to 80%. So you see how strong this property is. Okay, we're on a fairly tight timeline. So, and I do expect this to fill up pretty quickly. It's, in my opinion, it's an awesome investment. We're really excited for it. It's a mark to market deal, so it's not a huge lift. It's fixed rate debt, so we like the lack of risk in the debt, of course, or in the debt. Of course, there's always risk to any investment, but we feel like this one's pretty solid. So commitments today, remember it's 506C, so you have to be accredited, sign the subscription agreement. Everything's in the portal. Do that as soon as possible. And then funding deadlines December 17th. We're going to close no later than the 27th of December. We'd actually like to close earlier than that if possible. So our goal is to close the Friday before Christmas. So I think that's like the 20th or 21st. What are the key takeaways? What do we like? What do we like here? So Louisville, again, really strong, stable cash flowing market, leads the nation in rent growth. One of the best economic growing cities in. We love it. We love what's going on in Louisville. We own properties in Louisville, in Lexington, so we really know the market and we really enjoy those markets. 2023 build. 2024 certificate of occupancy, highly desirable townhome community, and an excellent growing submarket. We love the submarket. We love the property. This is one of the properties that you say, like, we want to continue to buy these types. Low vacancy rate, 5-year fixed rate debt, 65% loan to value. And again, pretty good interest rate locked in. Cash flow year one, 6.14% is what we're projecting. Double 2x equity multiple, so 19 to 24% projected annual returns, so over 2x equity multiple. Mark to market, we feel that rents have a lot of room to grow. And then the last one, and this is maybe one of the more exciting ones, is that the current residents earn 4 to 6 times the average rent. So it just proves our case that we definitely have some room here. All right. Just some Q&As. So general partners are investing a significant amount of money. Minimum investment again is $500K. We do take 401Ks, 7% pref, as I mentioned. So, all right, Drew, do we have any Q&A items?
Nothing yet.
Okay. If you want, you can go to the portal right now. If you have access to the portal, everything is up in the portal. So you're welcome to make a commitment. That QR code that's on there, you can just scan that and get right to the portal. Otherwise, you can go through our website too, which is enduruscapital.com, hit the login, go to the portal there, create an account. I'm going to be sending out an email with this video recording and access and links to everything. So Make the commitment. It's first come, first serve. I do expect it to fill out pretty quickly. So I am mostly available the rest of today. Feel free to call me. I will be available most of this weekend. Again, feel free to call me or email me, and I'll try to get to you right away. All right. No questions? All right.
No.
Well, that's it then. That was easy. Drew, we'll talk to you later. Everybody who was listening, appreciate you listening, and reach out if you have questions.
Oh, wait, hold on. I do see a couple popped up here.
Okay.
Um, what do you expect the bonus depreciation to be on the amount of $500,000 investment?
Yeah. So bonus depreciation, we expect to be about 50-ish% right now. It's hard to say, but potentially 100% could get passed and be retroactive and actually count towards 2024. We'll see. I mean, there's been a push to do it, and now I think there will be a renewed push to do it, but we can't promise that. So right now, 50%.
Another question was any additional retail being built in the area?
Yeah, there's that Hy-Vee that's going in. That's the big one that I know of. I know there is a strip center that was being built or is being built right now. I don't know exactly what's going in that. But yeah, there's more retail being built in that area. It's just going to continue to grow.
When we talked with the locals in the area, that area is called Fern Valley. It's kind of the more local, and that they said 10 years ago this was all cornfields, right, and farm fields, and so this is right in the path of progress. So both this property and pretty much everything around it is brand new. So it is right in the path of progress for where Louisville is expanding.
Yeah, Drew, I don't know which way Drew and I both went to see the property at different times, and I don't know which way you drove to the property, but how I drove to the property, I actually went through a lot of horse fields, and I mean it was gorgeous. So I drove along a nice creek for a good part of my time, and you feel like you're out in the country, and it's like there's no way these townhomes that we're buying are right around the corner. And sure enough, all of a sudden it's like it turns from this beautiful horse fields and nice open property to boom, you're right there. So
What's current occupancy?
yeah, I think it's 94%.
Four. Yep,
Yeah.
that's right.
94, 95, right around there.
Okay, now I think we're done.
Okay. Yeah, and I would expect, so we're going to buy it before the end of the year. So bonus depreciation, it will actually happen in 2024. So for that, just to make sure you understand that, like it's not, this isn't a 2025 deal. You will get the full benefit in 2024. And when we'll buy in 2024. We're buying in the winter. It will be a little more difficult to raise rents in the winter. So don't start probably. I don't expect to see big rent growth happening until more like March 1st. So we'll have a couple of months where we probably won't raise rents too much.
Very good.
So, all right. Reach out if you got questions. Thanks, everyone.
Thank you.